Hi everyone, this is Patrick Donahoe at Paradigm Life. Just wanted to talk briefly about something that is very misunderstood, and it's the concept of putting money into a qualified plan on a tax, what's called tax-free basis, which is really a tax-deferred basis. So let's say you have an individual that's making $100,000 a year in total income. Okay, so if that individual puts $10,000 per year into a 401k, his taxable income is going to subsequently go to $90,000. So at this level, if he's in a 30% tax bracket, okay, he's going to save $3,000 supposedly. Now, this $10,000 is going to grow inside of this vehicle on a tax-deferred basis, which means if he has income during the year that comes from whatever the 401k has its funds invested in, he's not going to have to pay any type of short-term capital gains tax, long-term capital gains tax, etc. However, inside of a 401k, he is going to have to pay taxes eventually, typically upon distribution. So let's do some math around the distribution side of a 401k. So here we go. Alright, so if you go into a little calculator system that I have called Truth Concepts, to get more information on Truth Concepts you can visit www.truthconcepts.com. Let's just look at that $10,000 investment. So here we come. There's a little trusty calculator that I have. Blow that up a little bit. Alright, so let's just say somebody starts off investing $10,000 per year, and they make a total rate of return of 8%, and they do it for, let's say, 35 years. So their balance in this 401k, accumulates to $1.8 million. Now, is that their total spendable income during retirement? No. Okay, they have to pay taxes on that money. So let's figure out if they're in that same 30% tax bracket. Okay, let's go 1,861,021, okay, times 0.7% or 0.7, okay, which is basically 70% is spendable income because 30% is going to be taxed. Total spendable income comes to $1.3 million. Okay, so tax professionals, CPAs, financial advisors, financial professionals will say, well, what you're doing is you're avoiding paying taxes right now so that you have more money compounding that's in your favor. Okay, so what we can do is maybe analyze an investment where you have after-tax contributions, okay, and tax-free growth, tax-free withdrawal, such as a Roth IRA, which you cannot put money at 10% or $10,000 per year. You're limited, and you're also restricted to income as well. So individuals making beyond $100,000 are not able to invest in Roth IRAs. Let's say you're underneath that level, and you let's say they raise the limit to $7,000. So if you want to contribute $10,000 per year into something, but it's after tax, you're only going to be able to contribute $7,000, right? Looky. Same exact dollar amount. 1,302,714. So it doesn't matter whether you use a post-tax investment or a pre-tax investment strategy. You're still going to end up paying the same taxes. Now, you're going to have more money compounding for you, okay? However, you're still going to have to pay taxes on all those distributions inside of these qualified plans. So now it comes to the question, do you think taxes are going to be higher today or higher in the future? Given the amount of government spending, given our deficits, just go to David Walker, who was the comptroller of the currency that resigned from that position, but he was the comptroller of the currency, and basically the comptroller of the currency is the general accounting office of the government, but they analyze the books of the government, and he said after he resigned that the government is going to have to double taxes and decrease spending by 50% in order to get out of the situation that we're in right now. So doubling taxes would mean that there would be higher taxes in the future than there are right now. So it might be wise to use a post-tax contribution method as opposed to a pre-tax contribution method. That's all for today.